One of the interesting things about capital flows into Europe in 2018 was the percentage of indigenous money coming out of the European market, and that was around 38%. We saw about 21% of the capital coming from the US, which was 7% higher than the previous year. Interestingly, Canadian investment doubled, albeit it was still a relatively small proportion. Turning to the Middle East, about 12% of the capital flows came from that region. Interestingly, most of the money was sourced out of Israel, but also Qatar were investors in a number of important trophy assets across Europe. And finally, only 6% of the capital flows came out of Asia, which was a 46% reduction on the previous year. And most of those funds were coming out of Southeast Asia, with capital flows out of mainland China being relatively low due to capital constraints. One of the interesting facts about hotel investment over the last 20 years is how yields have compressed. If I go back to the early 2000s, it was almost impossible to find institutional investors for hotel assets, and yields would be in the region of 8 to 10%. Now, if you look at prime European assets, we can see yields as low as 3.5%, and indeed for trophy assets, they'll go even lower. Standardized budget hotels in key European cities are probably trading somewhere between 4.5% and 5%. Turning to the hotel cycle and how long it's got to run, that's the $64,000 question. I think at the moment we're in a good position. Certainly underlying trading is very positive. The general market for hotel investments, as I've just alluded to, is very positive as alternative investments become more sought after than core real estate. And I think providing the underlying economic activity remains pretty stable, I see no reason why the hotel market shouldn't continue to move forward in a steady direction for at least the next 5 years.